Hey everyone, welcome back. Sounds like quite a few of you out there wrestling with a big question. Should I incorporate my property portfolio or not? Lots to think about there. So today we're going to dive into some of the tax considerations that come with incorporating a property business. We'll be taking a look at this source, incorporating a buy-to-let property portfolio, tax considerations. Kind of like planning a road trip, right?
Yeah, I like that.
Got to figure out the best route and what to expect along the way. Like where are those scenic overlooks, and maybe more importantly, where are those toll booths hiding? Because nobody likes unexpected tolls.
Right, exactly. And just like picking a road trip route, there are pros and cons to incorporating. I mean, a lot of people see it as this like magical way to pay less tax on rental profits and maybe dodge that inheritance tax bill down the road, but
Yeah, but is it really that simple?
well, it's rarely ever that simple. A lot more to consider.
Okay, so let's break it down. The source mentions inheritance tax and rental profits tax as big reasons why people think about incorporating. But I'm guessing it's not just as easy as, poof, all your tax problems disappear.
You got it. Let's start with a big one, capital gains tax.
CGT.
Right, CGT. Now, when you transfer properties over to a company, you're technically selling them, which usually means a big CGT bill.
Ouch. Okay, but the source did mention something called incorporation relief. Is that like a secret shortcut on our tax map?
It can be. Think of it like hitting the pause button on that CGT bill. Incorporation relief lets you roll over that capital gain into the shares of your new company. So you're basically deferring the tax hit for now.
Oh, so it's not gone completely, just postponed.
Right.
Gotcha. So what happens when you finally sell those shares? Does the tax monster come knocking then?
You bet it does. CGT will be waiting. So it's important to factor that in when you're thinking long term. Now, on top of that, there's another layer to this whole thing, stamp duty land tax.
SDLT,
Yes, SDLT.
everyone's favorite. Why does that come into play with incorporating, though?
Well, because your company is essentially buying the properties from you. And even if it's the company's first property, you're probably going to have to pay that higher SDLT rate for additional properties.
So right off the bat, that's an extra cost to think about. And I'm guessing it gets even trickier when we're talking about more expensive properties, right? Like those high-value homes.
Oh, you're absolutely right. The source flag's a big warning here. Properties over £500,000 that are lived in by someone connected to you, like a family member, those get hit with a whopping 17% SDLT when you transfer them to the company.
17%. That's a massive chunk of change just because maybe your son or daughter happens to be living in one of the properties.
Exactly. They're trying to prevent people from using companies as a way to avoid those high SDLT rates that are meant for those really expensive homes.
Okay, so incorporating when you've got family living in some of the properties, especially if there's a mortgage involved, sounds like a recipe for a pretty hefty tax bill. Any ways to soften that blow?
Well, the source does mention a possible workaround. You could try transferring the properties to a commercial partnership first and then to your company.
A partnership. So kind of like a detour on our road trip?
Exactly. If it's structured right, it might help you avoid that 17% SDLT hit. But, and this is a big but, the partnership has to operate like a real business for at least 2 or 3 years. Separate bank accounts, regular meetings, keeping proper accounts, the whole 9 yards.
So it's not just a quick fix then. It's a real commitment. Got to have a real business purpose behind it. Otherwise, HMRC might come knocking, and those anti-avoidance rules, well, they could really trip you up.
Exactly right. And there's another catch. If any of the properties have mortgages on them and the new partner takes on some of that debt during the transfer, well, you could trigger SDLT again and wipe out any benefit.
Wow, so even our partnership detour has its own set of tolls. Is it ever a smooth road?
Well, it can be. For example, if spouses or civil partners are setting up a partnership for an existing business, in that case, there's no CGT on property transfers into joint names. It's considered a legitimate business asset then.
Okay, so incorporating when you've got family involved and mortgages on a properties, it's starting to sound a bit like navigating a maze, honestly. But what happens if you do manage to incorporate and that rental income starts coming in? Is that where the tax benefits finally kick in?
Well, not so fast. There's this thing called double taxation that we need to talk about when you're taking out rental profits as dividends from your company.
Double taxation, that doesn't sound good. Does that mean we're paying tax twice on the same income?
Unfortunately, yes. The company pays corporation tax on its profits first. And then when you, as the shareholder, receive those profits and dividends, you pay dividend tax on your personal income tax return.
So even though corporation tax is lower than the higher rates of income tax, you're still losing a chunk of your profits to taxes at both ends.
Exactly. Let's say your company makes £50,000 in rental profit. At the current 19% corporation tax rate, that's £9,500 in tax right off the bat. Then, depending on your personal tax bracket, you'll pay even more tax on the rest when you distribute it as dividends.
Okay, so while incorporating might have some tax advantages down the line, It's not a free pass. There are costs and complexities up front. And this double taxation thing sounds like a real headache.
It's definitely something to weigh carefully. Now, having said that, incorporating can be a really good strategy, especially for brand new properties, especially if you're planning to reinvest those profits for long-term growth.
So it's like choosing the scenic route on our road trip. Might take a bit longer to get where we're going, but the views along the way could be worth it.
Exactly. That lower corporation tax rate, currently 19%, can really help your portfolio grow over time. It's like compound interest, but with a lower tax drag.
Sounds like incorporating might be less appealing if you need to access those profits in the short term, but potentially very beneficial for long-term growth. Any other surprises on our tax map we should be aware of?
Well, there's a potential silver lining, even with this double taxation issue, the deduction of finance costs.
Finance costs, is that another way of saying mortgage interest?
Yep, exactly. Unlike individuals who can't fully deduct their mortgage interests from rental income anymore, companies still can before they calculate their taxable profit.
Wait a minute. So even though I can't fully deduct my mortgage interest anymore, if my company owns the properties, it can. That sounds like a loophole.
It's more of a structural advantage of incorporating, and it can be a real win for higher rate taxpayers even if they take out all their after-tax profits. It helps reduce their overall tax burden.
Okay, so that's a definite plus to keep in mind. So we've got potential CGT deferral with incorporation relief, possible SDLT savings with the partnership detour, double taxation on dividends, but then this mortgage interest deduction advantage. That's a lot to juggle.
It certainly is, and that's why it's so important to be clear about your goals, how much risk you're comfortable with, and your investment timeline. Are you building a legacy for future generations, or do you need access to those rental profits sooner rather than later?
So before we even think about incorporating, we've got to define our destination and choose the right vehicle for the journey.
Precisely. Just like with a road trip, there are different routes and vehicles that can get you where you want to go. Some might be faster, some might be more scenic, but the key is to pick the one that fits your goals and preferences.
So incorporating an existing portfolio versus building a new one, it's starting to feel like choosing between a sporty convertible for a quick joyride and a sturdy SUV for a long, adventurous road trip.
That's a great way to put it. And just like choosing the right car for your trip, incorporating needs, careful planning, and thought, there's no one solution that fits everyone. But with a little knowledge and some expert guidance, you can navigate those tax twists and turns and get to your financial destination.
All right. I think our heads are spinning a little bit after all that. It's like we've just gone through a roundabout a few too many times. Maybe we should take a minute to recap what we've learned about these tax implications before we
Yeah, good idea.
move on.
Let's do that. We started off talking about those tempting tax benefits, right? Lower rates on rental profits and maybe dodging that inheritance tax down the road. But then we hit our first speed bump, capital gains tax.
CGT.
Right? And that whole incorporation relief thing sounded pretty good at first, like a way to just avoid CGT completely.
Yeah.
Turns out it's more like a delayed payment plan. You just kick that CGT can down the road until you eventually sell those company shares.
Right.
And then, of course, we ran into another toll booth, stamp duty land tax.
SDLT.
Yeah.
Everyone's favorite. Even though the company's technically buying the properties from you, you still got to pay SDLT as if you were buying an additional property.
Exactly.
And that's where things got really complicated, especially with those higher SDLT rates for additional properties and that crazy 17% charge for high-value homes if someone connected to you lives there.
Yeah, that 17% SDLT can really catch people out. It's meant to stop people from using companies to get around those higher rates that are designed for expensive homes,
Yeah.
even if they're renting them out to family.
Right. We did talk about that partnership detour as a possible way to avoid that huge SDLT charge, but it didn't sound like a walk in the park.
No, definitely not a quick fix. You need a genuine business activity for at least a couple of years, or HMRC could see right through it. And then those anti-avoidance rules, well, they could really come back to bite you.
Right. And don't forget about those mortgages. If that new partner takes on any of the existing mortgage debt during the transfer BAM, you could end up paying SDLT all over again.
You could. There are definitely a lot of moving parts with that partnership approach, but it can work in some situations, particularly for spouses or civil partners who are running a business together, because they can transfer property into joint names without triggering that CGT.
Right, right. Okay, so we've got potential CGT deferral, maybe some SDLT savings, but then we hit another roadblock, double taxation on dividends.
Yeah, that's often a big sticking point for investors. You end up paying corporation tax at the company level and then dividend tax when those profits are paid out. They can really eat into your returns.
Yeah, that 50,000-pound profit example really drove that point home. Even with the lower corporation tax rate, you're still paying a lot of tax at both levels.
You are. It really highlights the importance of your investment time frame. If you need to access those profits quickly, incorporating might not be the best way to go from a tax perspective.
Right, but if you're thinking long-term and reinvesting those profits for growth, that lower corporation tax rate could be a real asset. It's like compound interest working its magic.
Exactly. And even with that double taxation issue, there's that potential plus side. We talked about the deduction of finance costs. Companies can still deduct their mortgage interest from rental income, which can make a big difference to their taxable profit.
That's right. I'd forgotten about that. Individuals can't fully deduct their mortgage interest anymore, but companies can.
They can. It's one of the key advantages of incorporating, especially for higher rate taxpayers. It can really help to balance out that double taxation burden.
Okay, so we've covered a lot of ground here, but I'm starting to see the bigger picture. Incorporating an existing portfolio with family members living in some of the properties, especially if there are mortgages involved, it sounds like it could be a very messy and expensive business.
It certainly can be. There are a lot of factors to consider, and you really need to weigh up those potential benefits against the complexity and the upfront costs.
Yeah, but it sounds like incorporating could be a really smart move for someone who's building a new portfolio from scratch,
Right.
or for those who are in it for the long haul and happy to reinvest those profits for future growth.
Absolutely. That's a great summary. Incorporating a property portfolio isn't a one-size-fits-all solution. It's all about understanding your goals, how much risk you're willing to take, and choosing the path that best fits your own circumstances.
So before we even think about incorporating, we need to work out where we want to end up, how much risk we can handle, and then pick the right vehicle for the journey.
Exactly. Just like planning that road trip, there are different routes and different vehicles available to property investors. Some might be more direct, some might offer more scenic views, but the key is to pick the one that matches your goals and preferences.
Well, I think we've given our listeners a pretty thorough overview of the tax side of things.
I hope so.
Hopefully they're feeling a bit less lost and a bit more confident about how to navigate this whole thing.
Yeah, and remember, just like on a road trip, it's always wise to have a map and a knowledgeable guide. Don't be afraid to get professional advice from a qualified tax advisor or solicitor. They can help you avoid those unexpected detours and make sure you reach your destination safely.
Absolutely. Expert guidance can be invaluable when you're dealing with these complex tax rules. But before we wrap up, I'm curious, are there other things beyond just the tax implications that someone should think about when they're deciding whether or not to incorporate?
That's a great question, and it leads us perfectly into our next segment where we'll be looking at those non-tax considerations, things like liability asset protection and the practicalities of running a company.
Sounds like we're about to shift gears and explore a whole new terrain.
We are. We'll diving into things like liability protection, the importance of keeping your personal and business assets separate, and all those ongoing responsibilities that come with running a company.
So stay tuned, folks. We're about to take a deep dive into the practical and legal side of incorporating a property portfolio. Buckle up. It's going to be an informative ride. Okay, so let's dive into those non-tax considerations then. We've talked about the tax benefits and the potential traps, but what about things like liability and the practical stuff that comes with running a company? It feels like we're moving from the math room into the driver's seat now.
Yeah, I like that analogy. It's really important to understand how incorporating affects your personal liability. See, when you own properties in your own name, you're personally responsible for any debts or legal claims against those properties.
So if something goes wrong, my own personal assets could be on the line?
That's right, but when those properties are owned by a company, you're creating a layer of separation between you and the business. Your liability is usually limited to the amount you've invested in the company itself.
Ah, so it's like putting on a protective suit before you handle something risky.
Exactly. It can give you peace of mind knowing that your personal assets are shielded. And that brings us to asset protection.
Okay, so how does incorporating actually help protect my assets beyond just limiting my liability?
Well, by separating your personal assets from your business assets, you're creating a clear distinction. So if you run into financial problems or legal issues in your personal life, those company-owned assets are generally protected from creditors.
So it's like building a firewall between my personal finances and my business finances helps stop any problems from spreading.
That's a great way to put it. Now let's talk about the admin side of things. Running a company does come with its own set of responsibilities.
Oh boy, I was hoping we could skip the paperwork and admin part.
It's not the most exciting part, I know, but it's essential for staying compliant and running things properly. You'll need to keep accurate records, file your annual accounts, and follow all the company law requirements.
So I'm trading in my landlord hat for a CEO hat, which sounds pretty cool until you realize that CEOs have mountains of paperwork.
Yeah, that's true. But don't let the admin put you off. There are tools and resources that can make it much easier, and many investors find that the benefits of incorporating are well worth the extra effort.
Yeah, I can see how that peace of mind that comes with protecting your liability and separating your assets could be worth a bit of extra paperwork. Anything else we should consider before we put the pedal to the metal and start incorporating?
Just one final thought: incorporating isn't a one-off decision. It's an ongoing commitment. You need to stay up to date with any changes in company law or tax rules that might affect your structure.
Right, so it's not a set it and forget it kind of thing. Got to keep our eyes on the road and adapt to any changes.
Exactly, but with careful planning, expert guidance, and a willingness to stay informed, incorporating can be a really powerful tool to build long-term wealth and protect your financial future.
Well, I think we've covered just about everything. We've mapped out the tax landscape, explored those potential detours, and even taken a peek under the bonnet at the admin side of things. I feel like we've given our listeners a pretty good roadmap for deciding whether incorporating is right for them.
And hopefully they're feeling a bit more equipped to make a decision that aligns with their own individual goals and circumstances. There's no one right answer for everyone.
Exactly. It's all about choosing the path that's right for you. So whether you decide to incorporate or stick with owning your properties personally, we wish you all the best on your property investment journey.
Happy investing, everyone.
And that brings us to the end of another deep dive. We hope you found this exploration insightful and got you thinking. Until next time, keep learning, keep exploring, and keep diving deep into the world of knowledge.